Here we are, it's that time again when the Bank of England makes a decision on what to do with the base rate, the interest rate that influences other key interest rates in your life. This decision is made by the Monetary Policy Committee, which meet 8 times a year. And on Thursday, the 7th of August, the group made the decision to cut the rate from 4.25% to 4%. 5 members of the MPC voted to reduce the base rate. 4 of these wanted it cut to 4%, while one person suggested a larger cut to 3.75%. And the remaining 4 members voted to hold it at 4.25%. But ultimately, it was decided that the base rate would be cut to 4% as part of the Bank of England's gradual and careful approach. At the last meeting in June, the base rate was held at 4.25% after being cut from 4.5% the month before. Now it's at its lowest rate in over 2 years. But what does it all mean? So, a quick explanation of the base rate. Now, this is the rate that the Bank of England charges lenders to borrow money. It influences what we are charged when we take out mortgages and loans and the interest that we earn on savings. So, when the base rate is higher, we pay more for borrowing, but we also get better rewards for saving. The base rate is moved up and down to control inflation, which is the increase in prices of goods and services over time. When inflation is high, it means the rate of things getting more expensive is speeding up. And when it lowers, it still means things are getting more expensive, but just at a slower pace. So when inflation is high, the Bank of England might increase the base rate to try and stop people spending as much. And the idea is if your borrowing is expensive, but savings rates are decent, you'll hopefully be spending less. This should, in theory, reduce the demand for buying stuff, and companies will then lower their prices or stop increasing them so quickly. And thus, inflation comes down and we go again. Now, the whole thing is a balancing act of managing rising prices against the risk of damaging the economy. So, we've already had 3 cuts to the base rate this year, and experts were previously predicting further cuts, taking interest rates down to 3.75% by the end of 2025. Now, the market still seems to be suggesting there could be another cut later this year, and one of the MPC members voted on this, although the Bank of England is continuing with its cautious approach. Andrew Bailey, the governor of the Bank of England, said the decision to cut interest rates was finely balanced. He said that interest rates are still on a downward path, with any future rate cuts needing to be made gradually and carefully. But anything could happen. So while global uncertainty seems to have reduced since the last MPC meeting, with the US reaching some trade agreements with other countries, we could still see big waves made in the future. And we've still got the upcoming autumn budget in the UK, which could have a massive impact on the economy. There's been lots of speculation regarding potential tax hikes and or spending cuts that could be announced, which then could see households squeezed, resulting in a knock-on effect on economic growth and could impact further rate decisions. Of course, as ever, there's uncertainty around what will happen. Everything can change, and none of this is guaranteed. What you can be sure of is that we will update you as soon as we do know what's going on with the base rate and what it means for your money. So, what does it mean for your savings? Well, the past increases in the base rate were good news for savers. We've been earning very poor levels of interest, but that started to change in late 2021 and got better and better. But since autumn 2023, rates have generally been falling as banks price in the predicted cuts. You'll find they're fast to pass these on, but slow to give us the increases. Now, many popular easy access savings accounts are now tracker rates, so they'll probably be dropping imminently in line with the cut. And since others are variable, they're likely to do the same. We've been seeing rates drop for some time now, but we expect to be kept busy over the next few days and weeks updating our best buy tables on becleverwithyourcash.com/savings. Now, if you've got a variable savings account, the rate could drop very soon. And if you're looking for a new account, you should try and lock in a fixed rate ASAP before providers make rate changes. And if we're expecting another cut later on in the year, as the market suggests, this trend of falling rates could well continue, so do act sooner rather than later. However, do be mindful of tax on savings interest too. So reports this week revealed that 120,000 more people are expected to pay tax on their savings interest than previously expected, taking the number to 2.6 million. And recent research by investment firm AJ Bell suggests that you don't even need a massive cash savings pot before you're dragged into paying tax. It suggests that basic rate taxpayers would only need £19,600 in savings before they hit their tax-free limit. And for a higher rate taxpayer, that sum halves to just £9,800 before they will face tax on their savings. Remember, any returns paid on ISAs will be tax-free, and prizes won from premium bonds are tax-free too. We've got more information on ISAs and premium bonds over on the website. Now, if you've got a mortgage, specifically a tracker or variable rate, it's better news for you. So the latest decision means existing tracker rate deals will also drop by 0.25 percentage points. And if you're on your lender's variable rate or SVR, you might see it come down too, depending on your lender. In fact, those with an average standard variable rate mortgage could save £40 a month on their repayments based on a loan of £250,000 over 25 years. And for someone with a £125,000 mortgage with the same terms, the cut means a £17 a month saving. But if you're already on a fixed rate mortgage, which most people are, nothing will change during your fixed period. It can be confusing to homeowners that despite the base rate being lower now compared to, say, a year ago, average mortgage rates are actually higher. This is because mortgage rates are actually influenced by swap rates, and these are influenced by long-term predictions as well as the wider economy and other factors. What it means is this latest base rate cut isn't going to prompt general mortgage rates to fall overnight. If we're expecting further cuts to take more time to come through, it could mean that there's not much movement downwards on new fixes for now. It's always worth speaking with a mortgage broker who can advise on different strategies, though since no one knows what will actually happen, this still won't guarantee any savings. And that's it. Thanks so much for watching. Check out these videos here for more ways to make the most of your money.